Hi everyone, Sam here. I am going to speak to you today about HMO mortgages. I have been speaking to a lot of clients recently about HMO mortgages, and it seems to be something that a lot of people are looking to get into over the next sort of 12 months or so. Definitely seems to be a hot topic of discussion, shall we say. Like I said, I put a post out on my Instagram a little while ago, just some basics really about HMOs, and the feedback and the comments and the messages I got off the back of that were, I was a bit overwhelmed, to be honest. So I thought I need to go into this in a little bit more detail. So what I've done today is I've come up with 4 quick tips on getting your, on HMO mortgages in general. So I'm going to go through them. I'm going to go through them really, really quickly first. I'm going to go through them in a bit more detail, break them all down, and then give a quick summary at the end. So the 4 tips for getting an HMO mortgage. Number 1 is thinking about interest rates. This is one thing that we need to have a look into, so we can be realistic about what interest rates we're going to be looking at. Number 2 is the type of valuations that you'll be getting when applying for an HMO mortgage. Number 3, we're going to be talking about experience, what levels of experience you need in order to get an HMO mortgage. And number 4, we're going to be talking about criteria, lender criteria when it comes to the HMO in particular. So they are the 4 things that I'm going to cover today. So number 1 was interest rates. Okay, so what we need to be wary of is that HMO mortgages generally across the board are going to carry higher interest rates than a standard buy-to-let mortgage, okay? First and foremost is generally it's more the more specialist part of the market that are going to offer mortgages for HMOs. Back in the day, go back not actually that many years, to be honest with you, it was only commercial lenders that really did HMO mortgages. Now the specialist market are doing it, and they're creeping into the sort of the less specialist part of the market. But let's be honest, you're not going to walk into a Santander and come out with an HMO mortgage. It's not their bag. So we're automatically looking at specialist lenders anyway, whose rates are going to be just that little bit more than the standard sort of buy-to-let rates that you're going to get with NatWest, Barclays Bank and these kinds of people. So we're looking at specialist lenders, rates are going to be a bit more expensive. Within the product ranges that lenders have, they will split it from standard buy-to-let and HMO. Usually they put HMO and multi-unit block in the same category. So a multi-unit block would be maybe a block of flats all on one title, no split leases, and just a mortgage on the entire thing. And obviously an HMO would be a building split into rooms that you're renting out room to room. So they kind of come under the same category. The rates are going to be a little bit more expensive. Generally, as a rule of thumb, add about 0.5% on, just to be on the safe side. So it's just to be aware that that the interest rates are going to be a little bit higher, and not all buy-to-let lenders will offer HMO products. It's a very specific product. It's not like you get a standard buy-to-let mortgage and then get consent to rent it out as an HMO. It is an HMO mortgage, particular product, and therefore it's seen by a lender to be a more advanced strategy. It's seen as to be slightly higher risk, and therefore the rate reflects this. So first and foremost, rates are a little bit higher. The fees tend to be also on the side of the specialist part of the market. So some of the time it might well be a percentage based fee, 1% of the loan amount, something like that. So it's just something to be aware of. Now, when it comes to interest rates though, and this is the conversation that I had, and this is going on a very, very minute tangent very quickly, is don't get too bogged down with the interest rate, because it's only going to be relatively short term. I'm going to come on to experience in point number 3, but just going ahead and giving you a little bit of an idea of what we're going to be discussing in that bit is, as your experience grows, the opportunity to get better lending will do so. So, what's available to you now isn't always what's going to be available to you always. And so if the interest rate is a little bit higher, just make sure that you're calculating your interest rates based on some slightly higher interest rates to start with, so that you can actually make sure it still cash flows. So that's really, really important to remember. So number 1 was interest rates. Number 2 is going to be valuations. Now, valuations when it comes to HMO, this is something that a lot of people get wrong. They presume that because this is an HMO, it's a commercial mortgage, and therefore they're going to get a commercial-based or a yield-based valuation. This is most of the time not the case at all, okay? So a yield-based valuation or a commercial valuation is effectively looking at how much money gross that the property will generate on an annual basis. And then what a lender will do is they will multiply that by a certain amount, usually between 8 and 10 times, and that will be deemed to be the value of that property because it's based on a commercial style valuation. It's similar to what they would do with actual commercial properties, so shops, offices, that kind of thing. And HMOs in the past have been able to do that. Now, there is a way in which you will get one of those, and there's a way in which you won't. But let's start with just talking about why you might want one, why you might not want one. People get bogged down with, I want a yield-based valuation because I'm going to then be able to get a higher value. I'm going to be able to borrow more. I'm going to be able to pull more money out. I'm going to be able to reinvest that money elsewhere. The yield-based valuation is not always going to be higher than the bricks and mortar valuation. It depends whereabouts in the country it is. You know, if it's in London and the southeast, the bricks and mortar valuation might actually be higher than the yield-based valuation because yields in the southeast are generally lower. If you're looking in Manchester or some parts of the northeast, then yes, the yield-based valuation might be higher. So that's something to think about first anyway. But let's talk about when you would and when you wouldn't get a yield-based valuation. And when I say bricks and mortar valuation, by the way, I just mean like a standard normal valuation like you would get on a house. So this comes down to classification and permitted development and planning permission and things like that. So if you have a C4 property, so C4 classification will be an HMO between, well, any sort of HMO from what we would call like a mini multi-let all the way up to 6 bedrooms. This is classified as C4. Now, in normal places, you do not need planning permission to go from C3, which is a family home, to C4, which is an HMO. So from a lender's point of view, then they're not going to be giving you a yield-based valuation if your classification is C4, because you could quite easily convert that back into a standard buy-to-let family home relatively easily, and therefore should be based on a bricks and mortar valuation, and that could potentially put you in negative equity. So it's something to bear in mind. Now, the only way that this isn't the case is in an Article 4 area. You will need planning permission to convert between C3 and C4 and C4 to C3 and vice versa. And therefore, in some instances there, lenders can look at a yield-based valuation. But realistically, if the property could be sold relatively quickly as a family home, they're probably still going to be looking at bricks and mortar valuation. Now, if you go above 6 bedrooms, you will need to apply planning permission for what we call sui generis classification. Now, sui generis is Latin for no classification. And when you do get into the larger HMOs, this is when you will be looking at your commercial yield-based valuations, okay? Because the risk to the lender that you're going to be converting that back into a family home is pretty much, well, it's not zero, but it's not too far off that, because number one, it's definitely going to be set up as a proper HMO. 7 bedrooms, you know, that's going to be set up as an HMO. It's not going to be easily sold straight off the bat as a family home. So they're more inclined to be okay giving you the yield-based valuation, knowing that you're not just going to convert it back into a family home at some point in the near future, and then be potentially in negative equity, or the loan to value is going to be really, really high. And as I said, the sui generis classification requires planning permission as well. So you actually would need to get planning permission again to convert the classification back into C3. So it gives lenders that, I suppose, comfort in that what they are lending on is a commercial property. So just to quickly summarise that, because I know it can be quite confusing, you'll get a bricks and mortar valuation if it's a C4 classification in a non-Article 4 area. If it's in an Article 4 area, then you might, it's not guaranteed, but you might. If it's sui generis classification, chances are we will be able to get a yield-based valuation. So that's just keeping it clear. So when you are doing your analysis of potential deals, make sure you think about that point. If you are going to be converting the property into an HMO, will it get a yield-based valuation? Will it get a bricks and mortar valuation? Because the end value is so important when you're doing these deals, when you're buying, converting and refinancing onto an HMO mortgage. We want to make sure that the end value that we're looking at is genuine and realistic. So that's point number 2, valuation, something very important when it comes to HMOs. Now, number 3 I mentioned was going to be experience. Now, whenever we're looking at finance that is a little bit more advanced and the strategy is deemed to be, a little bit higher, lenders want to see experience. Now, you might say it's a bit of a chicken and egg scenario. How can I get experience if I can't get a mortgage? Well, actually, the experience that we're after here is just letting experience. So that can be a buy-to-let mortgage, okay? So in order for us to open up the whole market, realistically, what we're looking at is we will need to see 2 years worth of letting experience before we can pretty much, on this piece of criteria, on experience, pretty much open up the entire market, okay? So you will need to get that experience before we can open up to the entire market. Now, you might be saying, well, I don't have that, but I still want to press ahead with an HMO. That is absolutely fine, but with a smaller pool of lenders to work with that don't need 2 years, maybe they might need 1 year or 6 months. Generally, it's probably going to be more 1 year than 6 months, if I'm honest. Then we need to just anticipate that the interest rates are going to be a little bit higher, unfortunately. Now, coming on to the point that I was making earlier on about these interest rates and things like that, when we're looking at experience, if the reason that we're not getting the best rates on the market for HMO is purely experience based, that is obviously going to change over time. And so what I say to my clients is, who don't have the experiences, don't let that put you off. Just do your sums and do your figures based on a higher interest rate. If we're still cash flowing okay in the next 2 to 3 years, then that's great. What we can then do is you can still buy that asset, you can still be generating income, and you can be accumulating experience, and we can then refinance when we get to the point where you do get better experience, you have got more experience, and you can open yourself up to more lenders. And then what we can do is your cash flow then goes up in that period. So you are generating cash flow in the short term, but you're then going to generate even more cash flow once we get to the point where we can refinance you onto a lower interest rate, and then therefore you get higher cash flow. Hopefully that makes sense. So basically what I'm saying is, in the short term, just because you don't have 2 years experience doesn't mean you can't have an HMO mortgage. It means we have a smaller pool of lenders to work with, and we will probably have to pay slightly higher interest rates. So as long as that can work for a couple of years, we're not going to go into negative cash flow. We can do that, and then we can refinance out afterwards if you want to get into HMO straight away. It might be that what I'm telling you now might change your strategy a little bit, and you might say, actually, what I'll do is I'll rent a property out in the short term as a standard buy-to-let, and maybe we'll do the conversion in a couple of years' time once we have the experience under our belts, which is also a pretty good strategy. I always use the analogy of when I'm a kid playing Super Mario on my Nintendo. Level 1 is buy-to-let, level 2 is HMO. You don't generally skip ahead to level 2. You complete level 1, you kill the boss at the end, and then you go to level 2. Property is very similar in that regard. So that's number 3, and that's experience. So number 4 then, of the 4 top tips for HMO mortgages, is criteria. Now, when I say criteria, I'm talking about the HMO itself. What does the HMO look like? What does it have to have? And generally, lenders will, because criteria for an HMO to get a license, to get the HMO registered, will change ever so slightly from council to council and local area to local area. Lenders generally will go off what the local area's criteria is in order to get a license and make your HMO registered. So to get the mortgage, they'll say, is the property a registered and licensed HMO? Yes, it is. So as long as it ticks all the boxes with that local council to become and get a license and be registered as an HMO, lenders are generally going to be okay with it. Now, where I've seen that there's been some additional criteria points that need to be covered, generally seems to come over the shared area. Now, if you are trying to maximize the rooms in your HMO, you might actually not have thought about having a certain amount of square footage of shared area. And this is where it can get a little bit more complex. And sometimes it can dig into your profit margins if it means you would have had a 5-bedroom HMO, but now you might only be able to have a 4. Some lenders will not include the kitchen space as part of the shared communal area. They will want to see a separate communal area on top of that. And this is where it will vary from lender to lender. So when it comes to the criteria, like the stage 1, if you like, is what does the local council need? Stage 2 is, on top of that, what does the lender need? And usually that's something to do with the shared area. So when you're making your plans up, when you're doing your conversion, you're buying a property and you're going to convert it into an HMO, what you want to be looking at is, okay, how many bedrooms can we get in here? And is there room for us to be able to put some shared space in there? Not just a kitchen, not just a utility room, but an actual shared area that is not connected to that kitchen. You know, a dining room, sometimes that's okay, but usually they want to see a separate shared communal area like a living room or something like that. So this is where you need probably a good broker to go and research the market for you based on your plans, and see actually whether that's going to cause you any sort of concern. So that's the 4th point. That's criteria. That's what you need to be wary of when it comes to that. So they're the four sort of quick top tips for HMO mortgages. I'm going to go through those again now very quickly for you. So number 1 was interest rates. Interest rates are likely to be higher. The standard buy-to-let lenders sometimes don't have HMO mortgages. We are going to be looking at the specialist market anyway, so interest rates on the whole are going to be a little bit higher. But even within those specialist lenders, they will have their own product range specifically for HMOs, if I can get my words out. And then the interest rates are going to be a little bit higher, maybe sort of 0.5%, something like that. Number 2 was valuations, a yield-based valuation versus a bricks and mortar valuations. We talked about different classification, C3, C4 and sui generis, C3 being a family home, C4 being a small HMO, and sui generis being 7 bedrooms and above. Outside of an Article 4 area, you can get permitted development between C3 and C4. Therefore, you're unlikely to get a yield-based valuation on a C3 property in a non-Article 4 area. You do need planning permission to convert it to a sui generis. So it's sui generis, which is Latin for no classification. It's commercial, and you'll probably get a commercial yield-based valuation. If it's an Article 4 area, however, you do need planning permission in order to convert C3 to a C4 and vice versa. So there is a chance sometimes in that situation where we could get a yield-based valuation. Number 3, there we go, 3, was experience. Generally, to open up the entire market, you need at least 2 years worth of lettings experience. That doesn't mean HMO experience, it means letting any kind of property out. But if you don't have 2 years, it doesn't mean you can't do it. It just means the pool of lenders is smaller and interest rates might be a little bit higher. But what we can do is we can get onto those rates in the short term and we can refinance later on down the line. So it's important to know what kind of rates are available to you personally and working out what the net cash flow is going to look like so that you're not in negative cash flow for that short period of time. And the last one, 4th, was criteria. Generally, lenders will piggyback off the local council criteria when it comes to getting licenses and registering your HMO, but they do generally have some other bits of criteria over and above that. This tends to be on the shared space sort of part of things. So outside of your kitchen, if there's some shared communal area, that's going to be of benefit, and usually there is something worked into the criteria with lenders that you will need a certain amount of shared communal space in addition to the kitchen area. So there are my 4 top tips for getting an HMO mortgage. Hopefully that was helpful. If you have, please subscribe on YouTube by clicking on the subscribe button and the bell notification, of course, and do make sure to go and follow me on my other social media platforms on Facebook, Instagram, Twitter, TikTok, LinkedIn. Just search for my name and you should be able to find me nice and easy. Instagram is @thesamnorris. Please comment below, let me know what you think, and I will be happy to answer any questions that you've got. Hopefully this was happy. Share it with everyone you know. Yeah, I'll catch you on the next video, guys. Thanks very much.